there is a feeling that haunts an entire generation. It is a gnawing suspicion that sits in the back of your mind every time you pay rent, every time you check your grocery bill, and every time you look at the price of a starter home. It's the feeling that the game is rigged. We look back at photos of our parents or grandparents in the 1950s and 60s, and it feels like looking at a different planet. On a single income, a high school graduate could buy a home, support a family, own a car, and save for retirement. Today, you can have 2 degrees, work 2 jobs, and still be one emergency away from financial ruin. We are told that if you work hard, you get ahead. We are told that technology has made us more productive than ever before. And that is true. We are more productive. We are working harder. But here is the terrifying question that no one on the evening news wants to answer. If we are generating so much more wealth than our parents did, why do we own so much less? This isn't just bad luck. It isn't just inflation. And it certainly isn't accidental. What you are experiencing is the result of a precise mathematical design. We are living through the greatest transfer of wealth in human history. It is a silent engine that siphons value from the labor of the working class and transfers it directly into the assets of the ultra-wealthy. The ladder hasn't just been pulled up, has been dismantled, rung by rung. Kea, we are going to look under the hood of the machine that did it. Kea, to understand why the middle class is vanishing. We have to stop looking at politics and start looking at the plumbing of our financial system. Most people assume that money is neutral, that a dollar is just a dollar, a measuring stick for value. But that is the first lie. In the 18th century, an Irish-French economist named Richard Cantillon made a discovery that should be taught in every school, but isn't. He realized that where money enters an economy matters just as much as how much money enters it. He described a phenomenon now known as the Cantillon effect. Imagine a tower of champagne glasses at a lavish wedding. The central bank holds the bottle. When they pour the wine, the new money doesn't fill all the glasses at once. It flows into the top glass first. The people at the top, the banks, the government, the massive corporations get to drink first. They get the money when it is fresh and valuable. They use it to buy assets, land, and stocks before prices rise. By the time the wine trickles down to the bottom glasses to the wage earners, the teachers, the shopkeepers, it isn't wealth anymore, it's inflation. The people at the bottom don't get the assets. They just get the higher prices caused by the spending of the people at the top. This mechanism is the root cause of the widening gap between the rich and everyone else. It is a system where proximity to the money printer is more profitable than hard work. But to truly understand how this machine was built, we have to travel back in time, because this has happened before. And every time it happens, it ends the same way. The year is 1716. France is bankrupt after decades of war. The treasury is empty, and the king is dead. Enter John Law, a Scottish gambler, mathematician, and arguably the father of modern finance. He approached the French regent with a radical idea: replace gold and silver with paper money. It sounded brilliant. Law established a bank that printed paper notes, backed by the theoretical riches of the French colonies in America, specifically the Mississippi Company. He promised that the swamps of Louisiana were filled with gold. They weren't, but that didn't matter. What mattered was the printing press. As Law printed money, the French economy exploded with activity. The aristocracy, who received the new banknotes first, felt incredibly rich. They bought country estates, fine art, and most importantly, shares in Law's company. The stock price of the Mississippi Company went parabolic. Paris was drunk on easy money. The word millionaire was literally invented during this period to describe the new class of instant wealth. But then, the Cantillon effect kicked in. The money began to circulate out of the salons of the elite and into the streets of Paris. The price of bread doubled. Then it tripled. The cost of living soared. The working class, whose wages remained stagnant, suddenly found they couldn't afford to eat. By 1720, the illusion collapsed. The stock market crashed by 90%. The paper money became worthless. But here is the crucial detail. The insiders, those who got the money first, had already traded their paper for real assets like land and gold. The common people were left holding the worthless paper. The wealth of France hadn't disappeared. It had simply been transferred from the many to the few. Fast forward 250 years. We are in the United States. The date is August 15, 1971. This is patient zero for the death of the modern middle class. Up until this moment, the US dollar was tethered to gold. Every $35 printed had to be backed by an ounce of gold in a vault. This imposed a physical discipline on the government. They couldn't just print wealth, they had to earn it. But the costs of the Vietnam War and new social programs were bleeding the Treasury dry. So, on a Sunday evening, President Richard Nixon interrupted popular TV shows to announce that he was temporarily suspending the convertibility of the dollar into gold. That temporary measure became permanent, and it changed the economic physics of the world. Look at this chart. It is perhaps the most important image in modern economics. From 1948 to 1971, the lines for productivity and hourly compensation moved together. If you worked harder and produced more, you got paid more. It was a fair deal. But look at what happens immediately after 1971. The lines split. Productivity continues to soar. Computers, the internet, and automation made us vastly more efficient. But wages, they flatlined. For 50 years, the American worker has produced more and more, but their share of the pie has stayed exactly the same. Where did all that extra wealth go? It didn't vanish. It went to the asset holders. It went to the top glass of the Champagne Tower. Since 1971, the financial sector has exploded in size, while the manufacturing base has hollowed out. We stopped making things and started making money. So how does this mechanism work today? It's not as simple as a king printing notes. It's a sophisticated four-stage cycle that extracts wealth from your pocket without you ever seeing a tax bill. Stage 1 is the crisis. It always starts with an emergency market crash, a war, or a pandemic. Fear grips the population. The government and central banks step in as the saviors, claiming they need to inject liquidity to save the economy. Stage 2 is the injection. Trillions of dollars are created digitally. But remember the Cantillon effect. This money doesn't go to your bank account. It goes to the primary dealer banks, the financial institutions, and the bond markets. Interest rates are cut to zero. Money becomes free for the people at the top. Stage 3 is asset inflation. With all this cheap cash, corporations don't build new factories or hire more workers. Why would they? That's risky. Instead, they borrow money for almost nothing and buy back their own stock, or they buy real estate. This pushes the prices of stocks and homes to all-time highs. The news anchors celebrate. The S&P 500 is at a record high. They cheer. They call it economic growth, but it isn't growth. It is asset inflation. The rich feel richer because their portfolio is up 20%. Stage 4 is the erosion. This is where you come in. Eventually, that new money leaks into the real economy. You go to the grocery store, and beef is up 15%. You look for a used car, and it's up 30%. Your landlord raises the rent. You ask for a raise, maybe you get 3%, but inflation is running at 8%. Mathematically, you are becoming poorer every single day, even if your paycheck stays the same. The value of your labor is being diluted to bail out the system. We just lived through the most aggressive iteration of this cycle in human history. Between 2020 and 2022, nearly 40% of all US dollars in existence were printed. We were told it was for relief. We got checks for $1,200. But while small businesses were decimated by lockdowns, the billionaire class added over $5 trillion to their net worth. Look at the housing market. This is the most painful wound for the younger generation. Why is housing unaffordable? Is it because we suddenly forgot how to build houses? No, it's because housing has been financialized. When the Federal Reserve pinned interest rates to zero, giant investment firms like BlackRock and Vanguard had access to nearly infinite cheap capital. They began buying up single-family homes by the thousands, turning owner-occupied neighborhoods into rental portfolios. You, trying to buy a home with your salary and a 7% mortgage, are not competing against other families. You are competing against a printing press. You are bringing a knife to a nuclear war. This has created what economists call a K-shaped recovery. If you are on the top arm of the two-kif, you own assets, you are flying. If you are on the bottom arm, if you work for wages, you are sinking. The middle class, which used to be the bridge between rich and poor, is collapsing into the abyss. If we follow this trend line to its logical conclusion, the future looks less like democratic capitalism and more like techno-feudalism. In the feudalism of the Middle Ages, you had the lords, who owned the land, and the serfs, who worked the land. The serfs owned nothing. They paid rent to the lord for the privilege of existing. Today, we are moving toward a similar dynamic. A class of asset lords who own the housing, the intellectual property, the algorithms, and the stocks. And a growing class of modern serfs who own nothing and subscribe to everything. You rent your music, you rent your movies, you rent your car, and eventually, you will rent your home forever. The World Economic Forum once published an article with the infamous headline, "You will own nothing, and you will be happy." People call it a conspiracy theory, but look at the data. It isn't a theory. It is a forecast. When the reward for work is lower than the cost of living, the social contract breaks. We are already seeing the cracks. The rise of populism, the civil unrest, the extreme political polarization. These are not causes, they are symptoms. They are the frantic thrashing of a society that knows it is being suffocated, but can't quite identify the hands around its throat. This is a heavy reality to accept. The system is not broken. It is working exactly as it was designed to work for the people who designed it. It is an extraction machine. But here's the truth. You cannot change the system. You cannot vote the Cantillon effect away, but you can stop being its victim. The first step is to realize that saving money is a losing strategy in a rigged game. When the currency is being debased, cash is trash. The only way to preserve your labor is to convert it into assets, things that cannot be printed. Whether that is real estate, stocks, gold, or Bitcoin, you have to think like the central banks. You have to move from the bottom of the champagne tower to the top. The great wealth transfer is happening right now, at this very second. The window to secure your position is closing. The middle class is being wiped out, but you don't have to go down with the ship. History warns us that when these cycles end, they end turbulently. We are in the late stages of a long-term debt cycle. What comes next will likely be the biggest financial shift of our lifetimes. If you want to understand these patterns, if you want to navigate the chaos rather than be consumed by it, make sure you are subscribed. We are going to track this collapse step by step.